Hi everyone, welcome back to Tax Tutoring and Training. My name's Hannah, and today's lesson is going to be all about taking the standard deduction on your income tax return. As always, there's guided notes linked in the description down below, so stay engaged and answer some practice questions to see what you learned. All right, so what are deductions in general? Well, deductions are any subtractions that a taxpayer might take from their adjusted gross income, or AGI. These reduce the amount of income that is actually taxed, thus reducing the amount you have to pay for tax. A taxpayer is eligible to take one of two deductions, the standard deduction or itemized deductions. The standard deduction is a set dollar amount based on the taxpayer's filing status. So if you're married filing jointly, you'll get this much on your standard deduction. If you're single, you'll get this much. If you're head of household, you'll get that much. And it'll go based on the order of the filing status. For example, married filing jointly is the highest tax bracket, meaning it'll be taxed at the lowest rate, meaning you'll get a higher standard deduction because you're subtracting that amount from your income, thus lowering the amount you have to pay. An increased standard deduction, though, is available if the taxpayer is 65 years old or greater and blind. There's a lower standard deduction rate for those that may be claimed as a dependent, though, on someone else's return. So I'm a high school student. I'm able to be claimed as a dependent. If I was filing for the standard deduction on my tax return, then I would have a lower standard deduction than someone who's already filing single because I can be claimed as a dependent on somebody else's return. Now, the standard deduction can't go below zero. So I can't take a deduction that's greater than my AGI. That's basically what it means. The other type of deduction is an itemized deduction, and these are reductions on the taxable income based on personal expenses that are specific. So these would include things such as high medical expenses, taxes from your state or local area. Those are specific expenses that would be able to be itemized. And this means that if you had this much in medical expenses, you take that much in deduction. If you have this much in state and local income tax, you take that much in deduction. It's like a little bit adds up to a lot for an itemized deduction, rather than taking a very large chunk, which is the standard deduction. So who cannot take the standard deduction? Those who can't take the standard deduction are those who file married filing separately and either spouse chooses to take the itemized deduction. Even if you're working with a taxpayer and they're filing separately, if they say, I don't want to itemize, I want to take the standard deduction because it's going to result in less tax for me, but their spouse is doing their tax return and you know that their spouse is going to be itemizing, then that taxpayer cannot itemize because one of the two is itemizing deductions. The other people who can't take a standard deduction is a non-resident or dual status alien during the tax year, or those filing for a short tax year due to a change in the annual accounting period. These videos are made specific for the Volunteer Income Tax Assistance Program, meaning that if you are wanting to be IRS certified to prepare tax returns under the VITA program, then these last two cases are out of scope. And if you're a taxpayer seeking help with a VITA site, if you are one of these two, if you classify under these two, we recommend that you go see help from a professional taxpayer. So how does age or blindness affect the standard deduction? Well, we mentioned a little bit earlier that age and blindness often increase the standard deduction, but what exactly qualifies as that? So taxpayers are entitled to the higher standard deduction starting the day before their 65th birthday, sorry. And taxpayers are entitled to a higher standard deduction if they're blind and they don't itemize. So we're going to go into one example of this. Sometimes there are itemized deductions that can be taken even if you take the standard deduction, such as qualified business income expenses. You can still deduct those even if you're taking the standard deduction instead of itemized. But if you're blind and you want to take the higher standard deduction, you can't take those additional itemized deductions. I know it's a little confusing, but just know that's kind of where the Venn diagram circles overlap a little bit. And in order to be qualified as legally blind, you have to have a certification from your optometrist. just to make sure that you're not walking around with your eyes closed, like, oh, I'm blind. Yeah, we don't take that. But if if only one spouse qualifies as either greater than 65 or blind, and your taxpayer is the other spouse and they want to take that higher deduction, they can take it only if they file a joint return, or if they file separately and claim a unique exemption. And unique exemption is basically just they're the only ones that can take the exemption. There's not another person who can take the exemption for the spouse that also has no gross income. So if you're a taxpayer and you want to take the 65th birthday or blind higher standard deduction with your spouse, then you have to file married filing jointly, or you claim an exemption for them because they have no gross income. Basically, that's how it works. So how are you determining which deduction is the best for the taxpayer, itemized or standard? Well, we use TaxSlayer, which is our tax computing software, and you'd enter in all the documents for both, and the tax software would calculate which is greater depending on the year that you're filing, because standard deductions change every year. That's just how it is. You need to look up the standard deduction rate for your year that you're filing taxes with. But as a go-to, taxpayers will benefit most from itemizing if they have mortgage interest, state or local income tax, qualified charitable contributions, unreimbursed medical and dental expenses, or other qualified miscellaneous deductions. These are just like indicators that, hey, you might want to look into itemizing for your taxpayer. Now, we mentioned earlier that there is some deductions that can be taken some itemized deductions that can be taken even if you took the standard deduction. And one of those, the main one, is qualified business income deduction. And the QBI is a universal deduction for pass-through businesses, including sole proprietorships. And a pass-through business basically means that you're not taxed at the business level and the personal level, like they're one and the same. So in this case, the amount is the lesser of 20% of qualified business income plus 25% of qualified real estate interest trust dividends. Or it's the lesser amount of 20% of taxable income from AGI. We have taxable income, which is AGI minus deductions, minus your capital gains and qualified dividends. So these two bullet points, you're going to want to take the lesser of, and that would be your qualified business income deduction for the taxpayer. The deduction is limited, though, for higher incomes above the threshold, and it's reduced by the deductions on self-employment tax, self-employed health insurance, or contributions to certain qualified retirement plans. This is basically because you're taking deductions when you already take deductions on self-employment tax or things like that, you're limiting your AGI. So you want to include those first before you take the 20% because the IRS doesn't want you taking extra deductions. That's just how it is, because they don't want you to have a lot of money because they're taking your taxes. Anywho, one last topic that I wanted to go over is kiddie tax. And this is just something that interns who are filing income tax returns or taxpayers who are going to file a tax return should know about. And this is basically a vocabulary word where children 18 or under have unearned income above a certain threshold, and that is taxed at the rate of the parents. And it's just a weird little caveat, but you should seek aid from a professional tax preparer, not the VITA site, if you have kiddie tax that is going to be paid for your children or your dependents, etc., because this is a really complex topic and VITA doesn't want to screw it up. So yeah. Thank you, guys. It's been great teaching you, but I wanted to let you know, because we covered both standard and itemized deductions, you probably have more questions on, well, what exactly can I itemize deductions with, and how does that compute to maybe taking a higher deduction than the standard? See my next video on itemized deductions if you want more information on that. All right, thank you, guys. Have a great day.